It's currently at fresh two-year highs near $91 per barrel as a U.S. stock market rally boosted the optimism that demand will improve in 2011. Sally.
Thank you very much indeed, Rico. Here's on there. Well, Bundeep Singh, Rangar, chairman of the consultancy IndusView, is here to give us your take on what's going on. I mean, Bundeep, when you hear about these statistics and figures, it sounds like it's not really in sync at all with what we're thinking about next year and what prospects we have ahead of us for most economies anyway.
Well, I mean, it's interesting to see because the predictions of past have not necessarily been accurate. And you have to see the price of gold as one barometer of where the investor sentiment and confidence is and what people are believing is going to be the case for inflation, which people have hedged against in the past. So it's going to be somewhere between $1,400 and $2,000 an ounce is one way to see the predictions for the future in terms of the mass market. But, you know, if you look at it, the worst is probably behind us, right? The austerity measures are in place. There's political stability, notwithstanding some comments recently in the UK. But by and large, the worst is over. China's on track. We're on track for 10% North growth in both China and India. So you've got a general global confidence that's, I think, underlying this drive towards a higher price in equities.
Has it got also something to do with, you know, the bond markets being not unattractive, but obviously in a tricky position where, you know, bond yields climbing, etc., and therefore the appetite for share markets is a bit more hotter, really, should we put it that way?
You could, but you know what's really interesting? For the first time in really decades, you had both bond and stock prices go up, which typically they're inversely correlated. But for the first time in years, you had that, and there's several predictions behind that. But I guess you've got bonds with yields that are relatively respectable and high, and therefore they're investment grade. Typically, and these are sovereign bonds we're talking about, so they're the safest of the safe when it comes to banks deploying capital there. And at the same time, you've got equity rallies on the basis of the quantitative easing down to austerity measures in place. So in general, there's not a negative strain out there that people are really worried about like they were 2 years ago with the housing market collapse.
Well, we will watch with interest to see what next year brings. But thanks very much, Bundeep, for coming in, and we'll see you later. He'll be back shortly for a look at today's